home prices hitting all new record highs over the last couple of years. It's got experts and everybody asking me, are we in another housing bubble like 2008? Let's just get right into it, folks. My name is Tim, and I wanted to bring my perspective to the real estate market coming from a mortgage broker's perspective, okay? I'm getting asked a lot of times from my clients and people in the industry, because we work a lot of real estate agents, like what we think is going on with the housing market in terms of data. Are we headed for a major crash? So let's cover some data. We're going to look at some supply. We're going to look at some demand. On top of that, we're going to go into all the data, and at the end of it, what I want to do is just bring this all together and let you guys know what I think might be happening in the real estate market. Whether now is a good time to buy, is it a good time to sell? What should we do? Hold or move on? Let's just get right into it, folks. So the first thing I think we need to talk about is going to be demand, right? What is demand for housing? Because what we've noticed over the last 2-3 years since the pandemic started was the Fed went in and started a program called quantitative easing, where they were actually buying mortgage bonds in order to drive the interest rates down, right? So yes, that did cause a lot more demand than what we'd have normally seen, because if the interest rates are super low, that makes housing a little bit more affordable. That's not the fundamentals that we need to explore, though. We know that they can manipulate the interest rates and make housing look a lot more attractive. But then if they raise the interest rates like what's going on now, then we could possibly face a huge crash, right? So let's just look at some different data points as to what the true demand is in the country. Okay, so looking at this chart here, this is your Federal Reserve economic data chart showing the demand for houses in terms of new home formations, new household formations. Okay, and all the way back here, you can get an idea of how much the country has grown. And I'll go ahead and link a copy of all these charts today in the description below so that you guys can check out the data yourselves. But here you can see that we've been pretty much steadily rising to the point where we're needing between 1.2 to 1.3 million new homes per year. And this is based on, and by the way, this is expressed in thousands. Okay, whenever it's expressed in thousands, that's why this 128,451 becomes 1.2 million. Okay, so the household is an occupied housing unit. So these are total housing units, and I think that's the best way to look at the demand. So what we know for sure is that we need at least 1.2 to 1.3 million homes per year just based on new home formations. The other thing that we also need to consider and look at is how many houses are destroyed every year, right? And in America, there are, let me just move myself here, there are at least 200,000 to 300,000 that are destroyed every single year because of things like natural disasters, fires, hurricanes, or they get destroyed because they simply become unlivable. Okay, so we could argue then that we're looking more towards, we're needing 1.6 million new units, maybe 1.65 new units, maybe 1.7 million new units per year in order to keep up with current demand. Okay, now, there are other factors to consider, which are things that a lot of other people are talking about, like things like, lending standards and things like that. We'll get into that too. But for now, I just want to visit the fundamentals. So we know the supply and demand is the key to the pricing. Well, we know what demand is. It's about 1.6 to 1.7 million units per year. Well, where is supply? Let's take a look at that. Now, this chart that we're going to look at is a chart that I feel like everybody is throwing around out there, and I want to explain it to you from my perspective, and then listen to other people's perspective as well, and you decide what you think is the most accurate definition or the most accurate thing going on with this chart. Let me just pull myself up at the top. And here is the month supply of new homes. And this is, again, Fred's website. This is actually going to show current supply of new homes. So a lot of people think this is really hitting the supply thing on the nose. And right here, what you can kind of see is that back in August of 2020, we only had 3.3 months supply of homes. And as the mortgage rates have gone up, you can clearly see that is starting to really get demand in line, because we see this spike in inventory, all the way up to 9 months. So we went from December of 2021, which is typically not a great month for real estate. It was booming almost on this chart, right? And all of a sudden we see a spike in inventory just flies up all the way to 9 months, like super quick. So, and I'll scroll out so you guys can kind of see the entire picture. All right, so here is the entire picture. And you can see through here, this is the Great Recession, this big gray area here. So you can kind of see the month's supply of homes there and how long it lasted. And you can see this jump, and boy, it doesn't paint a pretty picture when you look at it from this standpoint. However, I do have some more data, and I wouldn't leave you with just this, because a few minutes ago, we literally looked at how many units per year that we need, not how many months supply that we need. So, by the way, month supply is figured out by simply looking at the total number of housing units on the market right now, and then also looking at how long real estate transactions are taking to close. Are they more mortgage? Anyway, they use all these different factors to come up with a months of interest. Well, I'm sorry, a month supply of homes. Well, the reason why I want to look at units is because that's a moving target, and it doesn't really express how many units are on the market in comparison with the numbers that we just measured. So let's take a look at the total housing units in terms of units. Okay, so here you can kind of see, and I put this all the way out to the max, you can see the number of units. And this is through the Great Recession, right here, this big blurb, right? And you can see this is very much out of line for the rest of the market. These little spikes, peaks and valleys, are pretty normal for the market, but boy, these are some big spikes and valleys. Here's why I don't think that we could possibly be anywhere like 2008. Look at the inventory levels. We're literally sometimes going under 1 million. And this is not just like short-term data. This goes all the way back to at least 2016. And it looks more like 2013 when the data really started kind of trickling down. So what does this mean? Well, we need to look at how many houses are being built per year, right? Because maybe there's an issue with building. It's gonna be housing starts. So I did it annualized all the way from 1959, and the reason I did annualized is so we can see how many units per year, since we're measuring everything in years. The graph will generally come up on a monthly, but you can just simply go into edit graph and change it to annual right here, and you'll be able to see this as I'm seeing it here, and I'm showing it to you guys. So we already talked about the 1.6 to 1.7 million need for building per year, based on just new household formations and current supply being destroyed. And you can kind of see that almost always that was pretty consistent in terms of the numbers. Sometimes it would be a little lower, so it's kind of a balancing out thing. Other than this little tiny spike that we had in the 70s, and I don't know, a lot of people probably aren't familiar with this spike, but the reason that we had this little spike in the industry back in the 70s is because that's when they introduced the low down payment mortgage for everybody. So you're gonna see a little bit of a spike because homeownership went through the roof. But here's what I wanted to really get at. When you look right through here, right after the dot-com bubble, we're at 1.7, and this is where you start to see builders getting exuberant, right? 1.7 million starts. 1.8, whoa, we're 100,000 over, right? 100,000 over. Let's call it 250. 350 over. Whoa, 2 million starts. So we're almost 250, 255. 650, I'll throw the math up here. 650,000, okay, 18, another 100, 750. So we've overbuilt, let's say 1 million. Let's say we overbuilt by 1 million, somewhere between here and here. That does seem to make sense when we look at this chart here, right? Overbuilding, overbuilding. Okay, so here's where it gets interesting, folks. 1.3 million. So we definitely are a little bit under, but that's okay because we overbuilt. 900,000 minus 600,000, 700,000 units. So keep in mind, we're only over for 1 million, if that's on the generous side. Now we're under by, let's say, 600,000. Now we're under by a million. So we're under by a million plus 600, so now we're 1.6 underbuilt. Another million, 2.6. All right, in 2013, less than a million, so you can kind of see. Here's the bottom line, guys. The bottom line is, without even considering the quality of the mortgages, which we'll just get into in a few minutes, and we'll briefly discuss it because I'm sure most of you are familiar with it, but the bottom line is this. The data is nothing like 2008 when it comes to the two most basic fundamental questions in the real estate market, which is supply and demand. So I know there's going to be some people telling you that, hey, we're in a housing crisis and we're about to crash 40% in value. Does that make sense? Not to me. In 2008, when we had all of the homes that were built, we had the oversupply, we truly had an exuberant market. That was totally a different market in terms of the fundamentals of supply and demand. On top of that, we were making these things called stated income loans, 100% loans, subprime loans. I think the average FICO score in 2006, 2005 era was 670. Now we can see that number much above 650, 750. So we're talking higher credit quality. Most people are putting a down payment, if not a small one, a very significant large one. So guys, the bottom line is this. There's way too much underbuilt supply or underbuild of our supply in order to cause a real estate crash of 30% or 40% of equity. Anyway, folks, I know there's a lot of different information out there. I just wanted to bring it to you from my perspective as a mortgage broker because I'm really into the data, and I think if we just look at the data doesn't suggest that. What it does suggest is that because we are slowing down and we're seeing the Fed move up the interest rates, it's probably going to create a buying opportunity for some of you out there that have been looking to buy and couldn't get into something very affordable. All right, folks. Anyway, that's all for today. Thanks for tuning in. Until next time, consider liking, subscribing, and sharing. All right, we'll see you, folks. We just look at the data doesn't suggest that. What it does suggest is that because we are slowing down and we're seeing the Fed move up the interest rates, it's probably going to create a buying opportunity.